name is Errol Zeki, and I'm the Chief Executive at Sasfin Wealth. So on behalf of David Shapiro, Sasfin, and myself, I'd like to welcome you to this live webinar. It's great to see so many of you online, and thank you very much for giving up your valuable time to come and listen to our story. The first quarter of 2021 is behind us, and at this point, we are more than a year into lockdown and this pandemic, including its devastation directly on health and lives, as well as the economy and livelihoods. And just once again, on behalf of Sasfin, I'd just like to extend our deepest sympathy to all those who have suffered loss or personal loss rather during this pandemic. On the fiscal and economic side, the impact's been huge. There's been this no expense spared response from global central banks. And really this response has sparked a debate around whether we are in a reflationary environment or whether we're heading for inflation. Just to say that reflation would be an uptick in growth of prices after a broad contraction. So in other words, it's actually quite a good thing versus inflation, or what we would term bad inflation, being sort of price increases above the long-term trend. The other big variable at the moment, of course, is the pace and success of the global vaccine rollout. These and many other issues have created a huge amount of volatility in global markets recently, including South Africa. And my colleague David Shapiro, who is the Chief Global Equity Strategist at Sasfin Wealth, will do his utmost to try and make sense of this all for us this afternoon. As always, during the presentation, if you have any questions, please post them to the chat. We will try and group and combine the most common questions and respond to them after the formal part of the session. But with that, let me hand over to David.
Thanks, Errol. And thanks everybody for attending. Analysts believe that Volkswagen's new electric vehicle encompasses better levels of technology than Tesla. And I'm saying technology. These are the analysts who say that horsepower is now being replaced by chip power. And it's estimated that in these new generation of motor vehicles, they will have between $2,500 and $3,000 worth of chips and semiconductors embedded in them. So for the meantime, electrification is actually becoming a big theme, not only for the motor manufacturers, but also for the designers and producers of semiconductors. NVIDIA, Broadcom, Infineon, there are many, many others that are very, very well placed to kind of benefit from this. In battery development, the whole move now is to reduce the size and weight of batteries, but to double their output and double their power. It's not easy to find battery companies, certainly kind of in the markets that we deal in. There's CATL, which is the Chinese business, LG Chem, QuantumScape, some of the big names that are being talked about. But I haven't quite found one particular company. I suppose an ETF could suffice. But for electric car makers, I think batteries are the critical component. And the important topic that fits in with electrification is the need to secure metals essential for manufacturing batteries. And we've had quite a few questions around this. Now, according to the Financial Times, and I read an article that I didn't understand, so I'm going to give you what I took out of it. An electric passenger vehicle needs around 20 kilograms of nickel in its battery. For some reason, Tesla needs 30 kilograms, up to 20 kilograms of cobalt in the cathode, and roughly 60 kilograms of lithium compound. So it gives you an idea what you need just for one battery. And now nickel is crucial as it helps batteries store more energy and cuts down on the need for more expensive cobalt. So cobalt, in fact, if you followed it, its price has gone up from about $32,000 a ton up to $52,000 at the moment. So that gives you an idea of the kind of gains that we're starting to see in these prices. Naturally, this has led to a stampede to secure supplies of these and other rare earth metals, particularly those that are needed in military, battery operations, and renewables. And if we look at rare earths, they're used all over the place in fighter jets, electric vehicles, and the trade war with China and the disruption that we saw with COVID, and also to some extent the recent trade blockage that we saw in the Suez Canal, has now raised many governments' fears of the dependence on foreign producers of these essential metals and minerals, as well as other things like semiconductors and medicine. So you've got now this move to actually secure the supply. And another big reason is that China controls by far the biggest supplies of rare earth metals, and also has gone out and bought supplies of cobalt. It has control of about 72% of production, and lithium about 61%. So China's gone out, not only producing rare earths within China, but gone out and bought access to these other metals. Overall, we're very bullish on commodities, boosted by growth in demand that we're seeing now as economies improve, and also tight supplies. Remember, there's been very little investment in actually creating supply in the mining industry, and this demand is going to go up on the on the improvement in the global economy. But apart from an increase in metals like copper, iron ore, PGMs, we're also expecting lithium, cobalt, nickel, and rare earths to flourish as these governments and manufacturers themselves rush to secure supplies as well. So in this, we're playing it safe, or certainly I'm playing it safe, not going obscure in the commodity space. And I think that if you look at BHP, if you look at Anglos, if you look at Glencore and even South 32, I think you can cover yourself quite well in the area. I do say that from battery manufacturers, it's not easy to actually find one particular or couple of companies that you can really feel secure. Just, if we look at the first quarter, most of the international markets are trading at record levels, or at least at multi-year peaks. South Africa too is at an all-time peak. And like other markets, we look like we're going to continue higher. I just glanced to the side and I see that when New York opens, we're going to open at another new high, and there's another big surge coming in the NASDAQ. And, when we look at these gains, it looks like it's pretty obvious. But, if we go back to January the 1st, we've shrugged off a lot of issues in the first 3 months. Remember, on New Year's Day, we still had Donald Trump in charge of the US. At that point, he was challenging the legitimacy of Joe Biden's victory. There were still those 2 Senate seats up in Georgia. They were up for grabs, which could easily have gone to the Republicans. And if they would have gone, it would have made it impossible for Biden to have passed that 1.9 trillion stimulus bill, and even for him to consider this 2.25 trillion infrastructure program that he's going to put before Congress or start discussing now. That wouldn't have happened if the Democrats had lost even one of those Senate seats. Naturally, the big driver of the market has been a successful rollout of the vaccine, even though we're getting areas like Europe and Canada falling behind. But with each day that passes, I think confidence is increasing that we're nearing the end of the danger zone. But just think, there have been other scares that we've just managed to brush off. Storming of Capitol Hill, which was on January the 6th. And then there was the GameStop saga. This is where those retail investors try to overwhelm short sellers of GameStop, which is nothing more than a bombed out computer game retailers as well. But the media went into a frenzy about the Main Street Davids taking on Wall Street Goliaths and what this is going to mean for the future of the hedge fund investment and even the market. And it turned out to be nothing more than a one-week wonder, as was this whole debacle over, is it Archegos? I never know the right pronunciation, but I'm going with Archegos Capital, where, the selection of stocks were hammered when a family office was forced to dump a whole lot of stocks onto the market to meet margin calls as gain. The media hasn't stopped forecasting the systemic risks and how it's going to shake up the industry, even though banks like Credit Suisse, Nomura, and so on have bloodied their noses. So, and when we saw the Ever Given, the massive Japanese container ship stuck in the in the Suez Canal, another call, this is the end of global trade, it's going to disrupt it, it's going to be inflationary, and so on. So we've had this. And of course, then there still is, as Errol referred to, the threat of inflation. We can't ignore this, or threat of reflation. I don't know which word to use, but inflation still remains something that we have to keep our eye on. And when President Biden announced the 1.9 trillion stimulus package, the inflation hawks have been warning ever since that the US economy might overheat. and his $2.25 trillion stimulus package just has added to these concerns, even though the intention of Biden is to fund the program with tax increases. So predictions of doom have driven interest rates at the long end of the market significantly higher. Well, kind of relatively speaking, the 10-year bond, which was trading at 0.92% on the 1st of January, ran up to levels of about 1.75%, which is a 90% increase. But it's stabilized now at around about 1.70. In fact, just looking a few seconds ago, it's down at about 1.64%. So it has come back. But it's not unusual for rates to rise when economic activity picks up, because investors demand high returns to compensate them for the threat of inflation. In the same way that we demand higher salaries to offset the increase in the cost of living, you always see it with rental agreements. There's always a clause built in for what is assumed to be inflation. And always we tend to overestimate what the pickup inflation is going to be. So, but bond and equity markets can coexist in times of rising rates. But it was the speed of this rise from 0.9 to 1.7 in a matter of weeks that actually shook markets recently, and has raised this whole issue about rising inflation, about rising yields at the top end of the market. If you look at inflation very briefly, there are three drivers. One is the base effect. Oil was $40 a year ago, it's now $60. So of course it's gone up 50%. So there's a big increase in the price that you're paying for petrol, or in the US or wherever you are. That is one part of inflation. And I think there are a lot of prices that were down a year ago when we were in the depths of the crisis of this pandemic, and that have gone up. Yes, that's got to feed its way through the market. So we are going to feel it. Then with the lockdown, it's going to release a surge in spending, as we're starting to see. Spending is rebounding, is rebounding faster than production can keep up. So we're starting to see bottlenecks, temporary shortages in supply. We've seen it in timber. We've seen it in a number of commodities, and we've also seen it in things like semiconductors. So that can be risky, but eventually I think manufacturing will sort it out and level out. And then the third and the most dangerous is actually the self-fulfilling one, which is inflation expectations, where people in business actually expect costs to go up, and they adjust their mindset accordingly. And these are influenced by commentators, by forecasts, by surveys, and so on. And that's the one that probably poses the biggest risk. Now, the Fed can control the short end of the market, as our Reserve Bank as well. We can do, the overnight rates or short end of the market, but we can't control the long end. That's controlled by the market. Now, the Fed has tried to do that by introducing these bond buying programs, and that's to try and anchor the long rate and keep rates down there, because those long rates are very important. Those are the mortgage rates. Those are the rates at which companies borrow, in longer term borrowing and so on. But they can only do it to an extent. Treasury markets are far too broad to actually exercise complete control over that. So up to now, the Fed has kept a grip on inflation, and that's allowed them, by keeping that grip over the last few years. And this is not something new. It's been happening over the last 10 years, where inflation has been a threat. But the Fed has managed to keep control or a lid on those rates. But we're getting to a point now where we are expecting inflation to go higher. In fact, Texas Fed Governor Robert Kaplan yesterday said he wouldn't be surprised if inflation shot up to about 2.5%. But the view is that this is temporary, and that down the line, secular forces will come through, or structural forces will come through, and they will stabilize the rate around about 2%. And somehow the market seems to be believing that, hence we've seen the 10-year rate steadying at around about 1.6% for the meantime. When we get to levels where economies start to get to pre-pandemic growth rates, and the world economy is starting to look upwards, then we're going to get to a point where the Fed is going to have to start raising rates again as well. But this is still some time away, and we're not quite sure when we're going to get there. Commentators are saying at the end of 2022. The Fed says certainly not until 2023 or 2024. So there's a wide range of times when we will come to that. But I think, understand that having come this far, with the US economy beginning to gain momentum, the last thing the Fed wants to do at this point is engineer a recession by raising rates too early and knocking confidence. So they will continue to try and control rates and keep expectations down. To be fair, no one can really forecast the levels and timing of inflation. It's a very, very difficult thing to forecast. And no one really knows at what point, and this is the crux, what point will rises in inflation derail the equity market? What point is that going to happen? You know, that point where investors believe that the returns in the bond market will outweigh the gains in the equity market. In other words, when is it going to be better to switch? When growth starts to slow down or when government starts to take action? It could be at 3%, just depending on the strength of the economy, or it could even be as high as 4%. We don't know. But I think it's something that we have to watch. But for the meantime, I think equity markets are very comfortable with where we are with the implied inflation rate. So, but it's still an issue, I think, that we have to take very carefully, and hence, I just wanted to spend a bit of time on that. Just if we go back to markets now and look at them, it's been a pretty good first quarter. US, Japan, JSE record levels. I looked at Europe. It's at a 12-year high. It hasn't got anywhere close to its record levels, but still for Europe, we're quite happy with that. With markets at these lofty levels, we now have to identify the underlying themes that have propelled markets and understand whether these are sustainable. Yes, we're at highs now. Will the markets go higher? What are the themes that have driven it, and can they continue? And I think the most significant is the belief that we're a lot closer to the end of the pandemic than the beginning. The IMF said yesterday that they expect the world economy to grow 6% this year, with US and China driving the recovery. 6% a year. I always say it's like, yes, that's great. It's like going down in the first half of a football game or a soccer game. You're down 6-0, and in the second half you pick up 6-0. Pick up 6. You're still drawing, and that's where we are. But still, I'd rather that we were growing at 6% than not growing at all. So the US economy projected to expand at 6.4% this year, and it's hoped that it will regain its pre-pandemic sizes. It's exactly what I'm trying to say after last year's 3.5% contraction. China's economy is projected to grow at about 8.4%, and that's up from earlier forecasts of around 8.1%. So the IMF is upgrading its forecast. And of course, one of the reasons is because of the stimulus packages and also the very successful rollout of vaccines. In China's case, I think it's more than that. It's just its way that it handled the pandemic. It allowed its economy to normalize a lot more rapidly. It was the only economy that actually grew in 2020. So if we look at vaccines, its production is increasing all the time, rollout gaining momentum. US is now doing 3 million vaccines a day. And I think, another successful area has been the UK as well. But I mean, overall, things are starting to pick up there, all getting ready for the summer. I know all the major economies are talking or starting to ease lockdown, considering opening their borders as well. Unfortunately, opening their borders is going to be green, amber, red countries. Green where vaccine rollout has been successful. I don't know how it's going to work. Amber, cautious, red countries, South Africa, those that are falling behind. Sadly, I think our borders will be closed to South Africa's for a long time. And I think it is regrettable that developing countries are going to lag. Just while the IMF came out with these things, the one thing that is negative is that this recovery is going to be incomplete and unequal, just simply because these recovery paths are different across various countries. So it's not going to be synchronized recovery there. It's going to be a little erratic. I think the one thing that we have to cheer is what we are seeing in America. Manufacturing there is picking up at the fastest growth, and we've seen a lot. And it's also interesting to see a lot of manufacturing has been brought back to the US simply because I think manufacturers or suppliers and producers want to be close to the supply chain. So we're seeing manufacturing pick up there. Capital goods sales are picking up as well. And I think in order to avoid bottlenecks, factories are being run as hard as they can. On Tuesday, a gauge of services came out, which were at record levels. Haven't seen this ever. So it gives you an idea that people are returning. They are spending on services, which would be restaurants and hairdressers and all of those things. So it's not only manufacturing that is showing this kind of demand. And last Friday, it was a public holiday, but jobs, 916,000 jobs were added in March. That's in the US on recovery hopes. It still leaves 8.5 million people unemployed. But I think that if the vaccine continues and we see this program, the people gaining confidence, I think, and services, people go back to restaurants and so on, I think these jobs are going to come down quite a lot. I don't know whether they're going to get down to the 3.5% that we saw before, but I think big progress is going to be made along the way. So the big investment question is, as confidence returns, what's normal life going to look like? Are we going to abandon what we did last year, the stay-at-home lifestyles? Are we going to return to the office and the mall? Are our spending patterns going to change? What have we learned from COVID? So does this also mean that we give up our tech shares, and look for value? It's something that I'll talk about now, go to the COVID laggers. But there is one thing that I want to say before we discuss that. If we look at that 6% world growth, China will contribute 20%, America 14%, and India 8.5%. So of that 6% growth that we're going to see in the world economy, China going to contribute 20%, America 14% as well. So the Chinese economy has returned to those pre-COVID levels. And one thing for sure, from an investment perspective, we cannot afford to ignore China. I know that we don't like the politics, we get angry with them. There's a whole lot that we can be negative about China. But the one thing is that we cannot ignore it. Their economic and social transformation over the past 2 years has just been extraordinary. It accounts for 20% of total economic output at present, which, as we saw from these IMF figures, China's adding a lot more to global growth on an ongoing basis than any other country. Its stock market, if you go back to the year 2000, it's 25 times bigger than it was 20 years ago. Its bond market, 75 times bigger. Admittedly, it's they're not issuing dollars, dollar-dominated debt. It's very much a local currency and that. And the middle class now makes up about 50% of the population. So to a large extent, they continue to eradicate poverty. And as we see this economy evolve, the number of growth opportunities is becoming very compelling. Chinese economy is becoming a lot more digital, a lot smarter, and a lot greener than other economies that we know. They used to have this reputation of cheap manufacturing, no more. It's an economy that's going big tech, starting to innovate. Its R&D spending is twice that of the US. Startups, IPOs burgeoning, and also massive stocks of large computers, industrial robots, 5G, AI, cloud computing, big data are really powering what is a much smarter infrastructure than we're seeing in the West or seeing in America and other countries. And it's becoming a leader in energy transition with solar and wind installments. And of course, its demand for electric cars, as we saw with Tesla, is expanding dramatically as well. So, and also they're way ahead in battery technology. So China is not only are they leaders there, but they're also a digital disruptor. They're embracing e-commerce a lot better or a lot faster than anywhere else. It might be because they haven't got the malls that America built. They haven't got the legacy issues like that. And people who are in a metropolis, I think, find it much easier to use e-commerce than trying to find shops. It accounts for, I think, 60% of global economists. And in mobile payment solutions, Alipay has got 500 million users. WeChat Pay, 900 million users. So it gives you the scope of where they are in fintech. So yes, the spotlight is on China. I think America is going to remain a world leader, but they can't afford to be complacent. To maintain their leadership, they have to outsmart China, not try and do what Trump did, is vanquish or subdue them, etc. I think the only way is to start to think smarter and so on. So what are the big Chinese companies? We know most of them as well. So again, this is not easy to play. Tencent, Alibaba, Kuaishou, Mutai, I can never pronounce these, Meituan, Pinduoduo, Ping An and Insurance, China Construction Bank, JD.com, Baidu, NIO, and so on. So we're playing China. Locally, we're buying the Satrix China, SDX CHN, and offshore, the same fund, which is an S&P fund. The code is GXC, which is the S&P China ETF as well. It just gives you a very nice exposure to these businesses as well, because it's not easy to actually buy into China. Just moving on to the themes that I wanted to bring up, with the IMF upbeat about growth and the vaccine rollout, raising confidence raising confidence to a point where it's going to release animal spirits, we're embracing ourselves for a summer of madness. I think, yes, we're all aware that the pandemic has brought forward the future. It's accelerated the way that we use technology, from video conferencing to online shopping and so on. It's fast-tracked the usage of technology to levels that wasn't expected for a long time. Just in a matter of weeks, we were propelled 5 years forward. We were forced to be propelled 5 years forward. And of course, 2021 is going to be a year where if we push for change, where we're going to, no longer protect existing jobs and outdated institutions. We're going to look for a new order. And you can see this from the push to electric cars. We're also embracing gender and race equality wherever, at home, schools, workplace, and so on. So the world is moving to build a new order, rather than looking back at last year's orders. So yeah, the pandemic has changed our behavior patterns. And even when we return to normality, I think the way we go about our lives, jobs, relationships are not going to be the same. But first, and this is what's interesting, we have to let off some steam. We have to get revenge. So as I say, as we get this confidence, as we get restored confidence in the community, I think the desire to go and cancel that Netflix subscription, burn those recipe books, head for the beach and just have a drink in a pub with friends, I think is going to be absolutely overpowering. And, and we can expect travel, shopping, socializing to be the big themes this summer. And I was talking about the northern, starting off in the northern hemisphere. I think there's going to be this massive releases. We've seen it. Cruises are all being booked up. Airlines, hotel groups are all reporting significant pickup in interest in bookings. And with travel comes the spend on luxury. So most travel and luxury groups, so leisure groups, have outperformed the broader indices in the US and Europe. Just Delta Airlines up 25%, Carnival, the shipping lines, the leisure lines are up about 30%, Boeing 21%, and so Airbnb 27% up. Booking, that's only up about 8%, but LVMH 13%, Richemont up 17%. So we're starting to see much better performance of these businesses. Food companies that did so well because we had to eat at home as well are probably going to lose out as people get back to socializing around the table and wanting to go to restaurants. And I think the same is going to happen with beverages. I think you're going to see a big tick up in the consumption of beverages and beers, as investors let loose as well. So, of course, it raises the question now, what about value versus growth? While there's a yearning to actually let go and make up for lost time, and that's powered the rush into value or old economy stocks, I think this will probably exhaust itself. As long as technology continues to disrupt and change the way that we live, I think that growth and thematic shares are going to dominate over value shares. I'm not a big one. I prefer to stay where we are. Central banks are going to keep interest rates close to zero. And in a zero rate environment, it doesn't suit those low growth, high return stocks. It doesn't suit those value type stocks as well. So, we pointed out that COVID-19 has amplified the digital revolution. I think it's going to continue. So, we prefer to buy tech disruptors on high PEs, even though the high PEs, they've got even higher growth trajectories and even higher returns on equity. So, these are businesses which might be at a 20 or 23 or 24 PE, but still their growth trajectory is 20% plus, and return on equity, 25, anywhere higher than that. So I'm going to end off by reiterating the themes that we believe in. E-shopping is still a very big theme, but it's changing. And it's such an interesting topic. What's going to happen. I know we all order from Takealot or Amazon as well, but there's going to be some kind of hybrid model that I think is going to emerge from this. Yup, with the lifting of lockdown, customers are going to go back to the stores. E-commerce will moderate, but I think the way that retailers now look at the market is completely different. By using data, this new age marketing, new forms of production are going to change and will change shopping forever. Shopping is moving now because of the digital revolution from what was a producer push. Woolworths would order 500 red jerseys and you would go in there and you'd have to buy them. It's now moving from that kind of situation to customer pull, where customers are now in charge and they decide what they want. So, from a consumer point of view, we've never had it so good. You can shop virtually, you can shop physically. For retailers, there's an adjustment period. They still have to pay the cost of the stores as well as digital advertising. They still have to display their goods in stores as well as on online search channels such as Facebook and so on. They have to pay for the cost of delivery now. That's what a customer wants because of e-commerce. And also, you can at the same time allow customers to come to the shop and return goods as well. So they've got to measure or straddle both of those as well. But I think it's still a major benefit to retailers. With social media, messaging apps, that's brought consumers and producers much closer together. They can look at the data, and if the data shows that people are doing yoga, of course, you can produce new yoga gear and so on. So it gives you a much better identity as to where your consumers are. So I think there's a closer relationship now between the customer and producer, and that's eliminated the middlemen, the wholesalers, and so on as well. I think the producer to customer is going to grow, and I think even if you look at Nike, their whole model, or Adidas, their whole model has changed, where they're going direct to the customer, rather than going through middlemen, through those kind of other shops. So yeah, it's changed forever. The one thing that we have to recognize as well, and you're going to see it, is that shopping centers have always been a place where people gather. They want to go there to chat. If you're lonely, if you're looking for a place of refuge, you go to shopping centers, you go into Starbucks, you sit there, have a cup of coffee, get onto your computer and so on. And I think they're going to continue to exist, but probably in new forms. And the other form that's going to change is something I mentioned when I did this presentation a lot earlier in the year, was e-commerce sites, I think, are going to go through transformations with development of chat box or virtual assistants, make it a lot easier to actually make it a lot easier to shop. Augmented reality, as I mentioned at the time, you're going to be able to see what you look like in a pair of glasses, what makeup would look like, or even clothes. And of course, there are going to be programs that allow you to sense depth and allow you to buy furniture, to see how a bed would look, or a piece of furniture would look in your living room, and so on. Just some other themes. Cashless transactions, we've seen this jump to levels that were expected in 2 to 5 years. So we've seen some big changes out there. The way that people are going to pay for things, they don't want to touch things anymore, and it's become a lot more sophisticated now. The whole way that we live in terms of using technology to open doors, start motor cars, that still remains a big theme. And the one that we're going to see roll out now, and we have to start to focus on, is 5G and cloud services. 5G, as I mentioned a few months ago, it's not 4G plus one. It's just transformative technology that's going to bring so many new capabilities and new opportunities. And the download speeds are just so significant. It's going to make it, there's no delay in transmission. So you can, orchestras can play together, operations can be done. I'm talking about medical operations. Vehicles can be driven. You can't have autonomous cars without 5G. You can't have interrupted transmission of the data as well. So we still see this as being a big theme for 2021 and going forward as well. As we learn to use 5G. So it still remains one of the big enhancements that we're going to see. Virtual reality, augmented reality, artificial intelligence, Internet of Things, self-driving vehicles are all going to come about with 5G. We can't ignore health tech. I think we have learned so much from this pandemic that is going to change the way that we conduct our lives, the amount of research that's going to go into looking at diseases. It's just going to cover so many areas, from public health to biotech, health sciences, medical devices, and so on. So it still remains something that you cannot ignore. The other thing is renewable energy. This is becoming real. And I think people want to live better lives as well. So as we've seen, the whole theme of this was, electric vehicles as well. I think you're going to want to buy an electric vehicle. It's just going to be something that's fashionable. You want to show off as well. I think, running around in an old car driven on fossil fuel, I think is going to attract a lot of criticism and so on. And of course, the other big thing is VTech, or the battery technology. Don't ignore it. And just the last one I want to mention is infrastructure. Infrastructure, we've seen what President Biden wants to do. A lot of it is he needs to catch up with China. But I think we're going to see this becoming a reality for the first time in a long time. He's adamant that he wants to go about it. If you look at America, if you look around the world, if you go to Europe or the UK, etc., there's so much that needs building and picking up. But it's not only digital infrastructure. It's literally the physical infrastructure as well that needs to be looked at as well. And of course, that's going to underpin demand for commodities. I'm going to leave some time for questions, but just in conclusion, I think the success of the vaccine rollout, together with the stimulus packages that we've seen, lifted confidence, going to lift growth in the world economy. Growth going to be lopsided, with emerging countries just kind of lagging the developed world. China and US going to come out a lot better than other countries. I think easing lockdown is going to get people out of their homes, traveling again, meeting friends, eating in restaurants. Still, I think that the economy that's going to emerge from the pandemic is not going to be like the one that we left behind. Our lives, jobs, relationships are going to change with technology. And I think this need for clean air is playing so much more. It's a much more important role in the way that we behave in the future. And of course, our business, our investment and business strategies and choices, I think, are going to have to be positioned to reflect these change conditions. Errol, I'm going to leave it there. I don't know if there's questions or anybody still around who wants to say anything.
Hi, David. Sorry, just trying to find my camera, but I seem to have found it. I seem to have found it. Thanks, David. We do have a few questions. Quite a few questions around electric vehicles, which is, I suppose, not surprising given the title of the webinar. But I think you've kind of answered most of those. There was a very specific question around whether the Tesla batteries and software technology, is far ahead of others, or is the world catching up?
Yes, they are ahead. They're well ahead, and they've had a long. They've been working on this for a much longer time. The point is, where is the development going to take? But I think there's so much attention being focused on it now. We can't really identify who's going to come out as the leader, and this is going to be the one area that propels all those motor manufacturers. I'm just worried. The one thing that concerns me is we're going to get remember beta, VHS versus beta and cell phones, etc. Because at the end of the day, if you've got an electric vehicle, you're going to have to charge it. And the last thing you want to do is go drive around looking for a Tesla garage or a VW garage or something like that. There's going to have to be a standard, which I think is accepted. And a huge amount of money in Biden's plan is around creating the infrastructure that's going to satisfy these batteries. So somewhere along the line, there's got to be a common battery. That's in the same way as we use a common fuel in motors today. Somewhere along the line, there's going to be something that is widely accepted. But I mean, the Volkswagen, these motor cars the share prices have gone up a lot, but don't ignore them. You know what I mean? Don't ignore the theme. Don't be the fundamentalist that we always are. The Amazon type analyst who said, no, don't buy it, share too expensive. No, don't buy it, share too expensive. We've done it on so many different occasions. Just watch the theme. That's what I'm saying. It doesn't mean you have to go and put your entire portfolio, but it's worth just putting a little out there and watching these motor men. We missed it. Have to admit, just bypassed us. But I still like Ferrari because there's still going to be those kind of people who make money and want to hear the roar of that engine and that. So, it's a small motor manufacturer. And I still think from a luxury brand, it still remains one of my favorite luxury brands. But it's not a motor vehicle. It can't compete with the electric vehicles. With what we're going to see in growth and development there.
Improving a bit on the Grand Prix at the moment.
Yeah.
Quite a few, and then David, I mean, quite a few comments coming through. That the first world, the developed world, will be adopting all these new technologies, electric cars, etc. But sort of comments around, does the emerging market, including South Africa, can we afford it? What about the infrastructure outlay? Recharging stations, all of those things. So to what extent does this sort of increase the gap between the developed and the developing world?
It's such an important point that you brought up. It's just so that's this inequality is actually going to widen. That's one of the IMF and everybody's trying to address it. They're very sensitive that the poorer nations are going to fall behind. Number one, we haven't got the vaccine rollout as far. We're not going to be part of it. And we, the people that should be part of it. So it's really tragic as the world goes to war. It's going to take time. Hold on a sec. Electric vehicles are very small part of the overall demand for vehicles, particularly because of the wide populations that we're seeing in India and various other places. But like China are pushing it. And if you're in a metropolis, if you're in a built-up area, I think you're only going to want electric cars. But I think we are going to fall behind. It's sad. There's still I'm talking decades. I don't think it's 1, 2, 3 years. It's going to take a long time before this is a theme, before 2030s, 2040s in those areas and that. But it's starting to gain momentum. But I don't think there's a right answer to that question. But it's yes, we've got to be conscious of it and work towards it. I think we'll get a hybrid here, maybe. We'll get something in the middle, yeah. Some like the Toyotas that we drive. It's still a big thing. The hybrids are still big, yeah.
And then, David, just sort of around some of your favorites. I mean, you used the GM Tesla example, and you also spoke to favoring growth and thematic shares over value still at this stage. I mean, and you covered quite a few themes during the session, but maybe just to recap on a few of the favorite actual companies that you're looking at the moment.
I'm surprised I haven't got Bitcoin stories. No one asked about Bitcoin.
We're getting there.
Have you? Oh, okay. I'll quickly go through them. You know, which are the shares that that we are still pushing. I think, the one thing that I still find, Errol, is that big tech is still dominant. It's going to take a long time before competition comes in and replicates the scale and these ecosystems. Whether in China it's Alibaba and Tencent, in the US it's Amazon, Apple, Alphabet, Facebook, Microsoft. These are massive businesses creating huge amounts of cash. Yes, the authorities are after them and they're answering a lot of questions, but you can't ignore how big they are, what they're doing with their money, and the amount of money that they're putting back into new products, into research and development. They're going to be political footballs, but I still think they're very well placed. So I haven't turned my back on any of those. I think the one that I like as well is with chips, with the semiconductors. There are a number of businesses you can buy. I mentioned some. I like ASML, which I keep talking about, which is right at the top end. They make the kind of machinery that allows that chip producers need as well, and they're way ahead of everybody. They're almost like a monopoly. And NVIDIA, I just think NVIDIA looks very good. I know there's been an interest in Intel and the factories that they're going to produce, but you can find Broadcom. There are quite a few other in this area. The ones that we've been buying are ASML and NVIDIA. And then once you go into the cloud, the digital revolution, Salesforce, Adobe look very good. I know DocuSign, we all are signing these documents now, has had a tremendous run, but I still think there's very good value in both Salesforce and Adobe. Digital payments, PayPal, Visa, streaming, Netflix and Walt Disney. We still like NextEra, which is it's a money-making a renewable company. That's why we like companies that actually still make money, that are not in dreamland. Healthcare, Philips, Medtronic, Novartis, J&J, all of these businesses are doing okay. I like the digital companies, so those are amongst a few. I'm not saying this is a complete list, but in Asia, I mentioned them: JD.com, Tesla, Tencent, Alibaba, Meituan, Pinduoduo, Ping An Insurance, and then if you're going to Singapore, SEA, very, very good business. Don't ignore our brands with the spend. I like the beauty products: Estee Lauder, L'Oreal, Home Depot. You can't ignore their numbers as people have still improved their homes. They're not going to go back to where they were. Nestle is very well placed as well. New management making a big change, and luxury LVMH stands out. Still our best. And of course, in the leisure space, Airbus, Safran, all of those companies are starting to do very well. So I think that's kind of a list. I snapped through that pretty fast, but those are still the shares that we're buying. We haven't really moved away too far away from where we were or where we have been. It's funny, if we look at this 10-cent deal, when we buy share, when you put together a portfolio and you want to introduce a new share, you always got to say, is this better than the worst one I've got in the other portfolio? In other words, what am I going to relegate? And I feel the same way with Tencent now. I'm quite angry that that process sold at 2%, because I think Tencent is such a super company. So we've got to keep asking the same kind of question. Yes, where we do get a company like this, do we add it? Do we add it at whose expense? So we haven't found reason to really make big changes to where we were in January. The only one that I have done, and I mentioned those, is I think don't ignore commodity shares here. And that's one big play that we've got in our market. I still like them very much. I think it's going to be a big theme. I know it's cyclical, and we get the story that commodity, but it's not even the cyclical nature of it. It's going to be what they produce. The prices can remain steady. It's going to increase production. They're going to sell a lot more of it. And that's where it's going to come through, just in the bottom line. not necessarily guided by higher commodity prices.
Thanks, David. There were quite a few of the attendees asking you just to repeat the name of those Chinese trackers that you were speaking about. I think there was the one Satrix one and the one S&P one.
So on the JSE, it's STXCHN, Satrix China. STXCHN. Go into it, look and see the companies that they own, and then the same one, it's exactly the same tracker. On the US market is GXC, which is the S&P China. GXC is the code on New York Stock Exchange or on the American stock exchanges.
All right. Thanks, David. I think we're going to leave crypto for today, but just one or two sort of on the local side. A specific question around construction in South Africa, and there was also just a specific question around what hope is there for Sasol, I think was the exact question.
Yeah, it's a difficult one. You know, Sasol is going to depend on where commodity prices go. I think it's favoring them. I still think they've got a lot of work to do. You know, don't dismiss what happened to them. They overborrowed. They got into huge trouble. They had to sell off some of their best assets in order just to survive. So I think it's taken a lot out of it. You know, it's taken a lot, and they still have heavy debt that they have to pay down. From my point of view, you know, those are companies I don't like. You know, I tend to avoid. They will improve. They've got good management now, solid management, but I think it's going to take a long time for them to get back to where they were. Remember, this was a 600 Rand share, you know, not where it is at the moment. So my personal view is I would rather go for a BHP, you know, rather go for, if you want to get into BHP, Anglos, even, you know, Glencore, which is much more of a trader. I prefer to go into those than to look at, say, even South 32, you know, got a much better array of metals. So I just think they're better placed. They've got no debt. They're generating a lot of cash. They're going to pay good dividends. You know, why look for a company that is still trying to find its way?
Thank you, David. I think we're going to leave it there for today. Thank you very much for the insights. Always a lot to consider with these. And then, you know, thank you very much to all the attendees for your precious time coming to listen to us. Just to remind you that this webinar plus a host of other content is available on the Sasfin Content Hub on sasfin.com. So please do go take a look. It is updated daily with fresh content. And enjoy the rest of your Thursday. Thank you very much. Thank you, David.
Pleasure. Thank you.